Picture a Tuesday morning. Not a public holiday. Not your rostered day off. Just a normal Tuesday. And while you were still asleep, something arrived in your account. Not your salary. Not a side hustle payment. Not a bonus you had to work overtime to earn. A dividend. Paid automatically by the companies you own a piece of. Paid whether you showed up to work that day or not. Paid while you were making coffee, sitting in traffic, or doing absolutely nothing. That is the idea behind building a dividend portfolio. And today, I want to show you exactly what it takes to get there as an Australian investor. Not theory. Actual numbers, a realistic path, and the specific Australian tax advantage that makes dividend investing here more powerful than most people in this country ever realize. By the end of this video, you will know the exact amount you need invested to generate real passive income from dividends. You will understand why Australia gives its investors an advantage that most countries simply do not have. And you will see why consistent action over time gets you there more reliably than any shortcut ever will. Before we get to the numbers, there is something about the Australian share market that changes everything. Australia has a dividend imputation system. Most countries do not have this. Here is what it means in plain language. When an Australian company earns a profit, it pays corporate tax on that profit, around 30%. Then it pays shareholders a dividend from what remains. In most countries, you then pay income tax on that dividend too. So the same money gets taxed twice, once at the company level, once at your level. Australia decided that was unfair and built a system to fix it. When a fully franked dividend arrives in your account, it comes with something called a franking credit. Think of it as a receipt, a record of the tax that was already paid on your behalf at the company level. When you do your tax return, that receipt reduces your tax bill. And depending on your tax rate, it can actually produce a refund. For a long-term dividend investor, this is not a small footnote. It can add the equivalent of 1 to 2 percentage points to your real annual return. Quietly, every year, without you doing anything extra. That difference, compounded over 10 or 20 years, is significant. Australia's dividend imputation system is genuinely one of the most investor-friendly features in the developed world. And the majority of Australian investors do not fully understand how it works in their favor. Now you do. Let us talk about what you actually need. Most people ask this question the wrong way. They ask, how much do I need invested? The better question is, how much income do I need and how reliable does that need to be? Start with the income target. Work backwards to the portfolio size. Based on current Australian cost of living figures, here is a realistic framework. A modest but comfortable lifestyle for a single person in Australia requires somewhere around $45,000 to $55,000 per year. For a couple, a genuinely comfortable lifestyle sits closer to $70,000 to $90,000 per year. Now, if you are building a diversified Australian dividend portfolio targeting a yield of around 5 to 5.5%, the math looks like this. For a single person targeting $50,000 in annual dividend income, you need somewhere in the range of $900,000 to $1 million invested. For a couple targeting $80,000 per year, you are looking at roughly $1.4 million to $1.6 million. Write those numbers down, not because they are fixed, but because having a real target changes how you make decisions. Most people never do this calculation. They have a vague sense that they need a lot invested to live off dividends. But vague goals produce vague results. A specific number gives your investing direction. And here is the most important thing about those numbers. Nobody needs to arrive with a lump sum. The overwhelming majority of people who build a dividend portfolio large enough to live off did it the slow, boring, consistent way. A regular monthly contribution. Dividends reinvested rather than spent. Time doing the work they were never willing to do themselves. This is where the dividend reinvestment plan becomes one of the most powerful tools available to a long-term investor. Most ASX-listed funds offer what is called a DRP, a dividend reinvestment plan. Instead of your dividend arriving as cash in your account, you choose to automatically reinvest it into more units of the same fund. This sounds simple, but over time it becomes something extraordinary. Think of it like a snowball at the top of a very long hill. In year one, the snowball is small. The dividends you reinvest are modest. They buy you a few more units. Those extra units generate slightly more dividends next quarter, which buy slightly more units, which generates slightly more dividends. Slowly, the snowball starts moving faster. The further down the hill it travels, the more mass it picks up with each rotation. In the early years, dividend reinvestment barely feels like it is doing anything. The numbers are small. The progress is invisible. But underground, the roots are growing. And at some point, the momentum becomes undeniable. Someone who begins investing $500 per month at age 30 and reinvests every dividend is in a profoundly different position at age 55 than someone who started the same way at 40. Not slightly different, profoundly different, because time is the one ingredient that cannot be purchased later. There is another structural advantage available to Australian investors that most people significantly underuse: superannuation. Inside super, your investment returns grow in a tax-advantaged environment. And once you move your super into the pension phase after reaching preservation age, your investment returns, including dividends and the benefit of franking credits, can effectively be received tax-free. This is not a gray area. It is precisely how the system was designed to function. For anyone building toward dividend-based financial freedom, combining investments inside super with investments held outside super creates two separate streams of tax-advantaged income. One that is locked until you reach preservation age. One that is accessible before that. Used together, these two streams are more powerful than either one in isolation. The investor who understands this structure builds wealth differently from the one who treats super as an afterthought. Now here is something that most videos about dividend investing skip. Inflation. If you build a portfolio today that pays you $50,000 per year, that $50,000 will feel different in 10 or 15 years. The cost of groceries will be higher. The cost of utilities will be higher. Everything will cost more. And a fixed income that does not grow loses purchasing power quietly year by year. This is why the quality of what you invest in matters as much as the yield itself. Well-managed Australian companies with strong earnings histories tend to grow their dividends over time. Not every year, not in a perfectly straight line, but over a long enough period. Dividend growth from quality established businesses has historically kept pace with inflation. This matters more than it appears. A company paying a 10% yield that cuts its dividend in 2 years is a worse outcome than a company paying a 5% yield that grows its dividend consistently for the next 20 years. Chasing the highest headline yield without considering dividend quality and sustainability is one of the most common mistakes new dividend investors make. The goal is not just income today. The goal is growing income over time. So what does the realistic path actually look like? It does not begin with having $1 million saved up. It begins with a decision. A decision that building passive income is a priority, not an accident. The first step is knowing your target. What annual income would allow you to genuinely reduce your dependence on a salary? Calculate that number. Then work backwards to understand what portfolio size produces it at a sustainable yield. The second step is building consistently. Monthly contributions. Dividends reinvested during the accumulation phase rather than spent. A diversified approach using broad market funds rather than concentrating in individual companies. And critically, not reacting to every market movement along the way. The third step is using the structural advantages available to you as an Australian investor. Superannuation for long-term tax efficiency. Franking credits working in your favor at tax time. Reinvestment plans compounding your holdings automatically. The fourth step is the hardest. Patience. Because the early years of building a dividend portfolio do not feel impressive. The income is small. The portfolio balance fluctuates. The progress is often invisible. But something is happening beneath the surface. And at some point, the portfolio reaches a size where the dividends start covering real, meaningful expenses. A utility bill. A car registration. A month of groceries. Then more. Until eventually, an ordinary Tuesday morning arrives. No special occasion, just a regular day. And money has arrived in your account before you even opened your eyes. That is not a fantasy reserved for people who were born wealthy. It is a math problem with a known solution. And the solution begins with understanding where you are right now, knowing exactly where you need to get to, and taking consistent action over time rather than waiting for a shortcut that is not coming. This video is for general education only and is not personal financial advice. Dividend yields, tax rules, superannuation regulations, and investment returns can all change. Your personal situation is different from everyone else's. Please speak with a licensed financial advisor before making investment decisions. Here on Ontim Finance, we explain money in simple words so normal people can make smarter decisions. If this helped you think about dividend investing more clearly, subscribe. And let me know in the comments, what is your passive income target? What would change in your life if dividends covered your basic expenses? I read every single comment.